Hi folks, Scott here, and this is the wrap for Tuesday, June 11th. So, interesting day here. Bulls and bears could probably both take something away that was positive as well as something away that wasn't positive. Huge gap down, finished about where we started. That's a win for the bears. The bulls could argue, hey, they weren't able to make any more progress, and we actually controlled most of the day. So you could argue both sides of this. A member in our trading room who has Gap Trader, does back testing as I trained him, and using his own creativity, noticed a unique pattern today that I thought I'd share with you. He noticed that we opened and closed below the red line, which is yesterday's lows. So we opened and closed below yesterday's lows, and we did not fill today's gaps. This is a scrunched up 5-minute chart if you're not sure of the S&P 500. So the high today was less than the blue line, opened and closed below the red line, yesterday's lows. And we're below the 10-day moving average. We closed below the 10-day moving average. We're still above the 200. And it has some really interesting results. So let me show you the results of fading gaps after an unfilled down gap that opened and closed below 2 days ago, and you're still above the 200-day moving average. And there you go. A couple things stand out, several things stand out that are very interesting about this. One, there's almost a 3-to-1 probability of gapping up based upon this particular pattern historically. See the number of trades, 46 versus 18 to the upside. So you'd short an up gap by a down gap. So odds favor a gap up based on this particular setup, and it's a pretty good historical setup in terms of win rate and profitability. But a down gap, if we happen to get one, though less likely, 18 of 18 historically, with an average winner of about 5 points. You take this number, divide by 500 to account for 10 contracts, $50 per point in the ES, and it shows you some good size wins, 18 for 18. Now you don't bet the farm, anything like that. These can and do fail from time to time. And as always, I'll defer to our gap guys before I make my final decision. And I'm going to rerun these numbers using our MTG stop parameters because this assumes an intraday stop. So it could be volatile after the open in one or both directions. But pretty interesting study, and I appreciate Pence in our trading room sharing this. All right, let's take a look at our worksheet and what it showed today. Worksheet's a summation. I started sharing this last year of our individual gap guides for all 8 indices. So it's sort of like a big macro view of the pressures in play in the market and what our gap guide shows. So at a glance, you can tell what's going on. Today, we were clearly opening down with big gaps below yesterday's lows. 50-50 win rate, 0.8 profit factor. I'm not going to touch that. That's a pure gamble. It actually shows a slight downward bias. So that's what we had in play today. None of the individual gap guides met my criteria. Certainly the ES did not, which is my primary instrument, nor the spider. There were no unique day factors that I also consider in play, nor any unique patterns that were overly good or bad. Right? Let's check out down gaps after this unique pattern defined down here. Just sort of neutral. Down gaps after an NR7 day, the most narrow range day of the past 7, neutral. So nothing compelling. Here was my summation for the day. In fact, I showed in last night's wrap, down gaps were generally neutral when closing below the 20 but above a 10-day moving average. But if you looked at only the large gaps, only 1 of 10 wins. Now, technically, today we actually would have made this 2 of 11, but by the narrowest of margins, and both in terms of where we finished the day, because we did not fill the gap. But you would have narrowly survived being stopped out as well, and it barely finished up. Look at this large down gaps above a 200, and when the 10-day moving average sloping down. The reason I used that, I don't talk about that one much, but we were close proximity to the 10 and 20-day moving averages. So instead of playing around with different permutations above or below when we narrowly closed just above one and just below the other, just thought it'd be a simple way to keep the sample size decent and keep the data more accurate. Just say the 10-day moving average is sloping down. Check that out. Terrible numbers here. So this one narrowly became a positive as well. But still, tough market, tough setup to fade. So overall, gap guides were neutral to weak, and mostly risk factors for large gaps. And as I said, the bulls have been omnipresent. So today may defy historical odds, but passing on fading, we'll look for opportunities to get short using the range guides. Likely look. And let me show you today's action. Russell, S&P, NASDAQ, and Dow sold off about 6 points. Gap guide showed a stop equal to 6.25 points. So depending upon slippage and your execution and timing, you may or may not have survived because the market sold off exactly 5.5 points today. See, that was 27, low 21.50. So very happy to not have had to endure that, but that was the low of the day. It rallied. I wanted to get short once we got back below the low, but I told people to watch out. Always pay attention to these boundaries, like within 2 or 3 points of the open in either direction. You can get chopped up. And I had to respect the higher high here, right, and the higher low. So short-term action was bullish. Avoided the temptation. Did not have any 15-minute range guides, which is based upon the pink lines or purple lines there, nor first-hour range guides that favored a trade in any direction except for the south side. We had a low breakout was favored in both. I set that up and never triggered, unfortunately, because I think we could have gotten a pretty significant move to the downside had it. Then we chopped around and did nothing all day. Did a discretionary trade to the long side. We ran some data on end-of-day studies that favored a bullishness to continue in the last hour if you were above the open, which we were, or bearishness to continue in the last hour if we were below the open, which we were not. So I went long up here and was stopped on that. It did not continue higher, rolled over, and then actually did a small trade here, discretionary. So I did 2 discretionary trades, different directions, and this one down here in part because the first one had failed, thinking and only risking a couple points, so no big deal here, but knowing that there was a chance if we got down and kept testing, ran to the lows, it would be a big kind of sort of violent move potentially. So call these inflection trades, 50-50 in terms of which way it's likely to go. Risk 2 or 3 points to make 6 to 10 is the goal, especially when the market's moving. But neither one panned out. Again, they were discretionary trades and indirectly based on probabilities. But none of my core trades triggered today, so nothing to report there. And we got some good movement. We'll see what tomorrow brings us. And there you go. That is the wrap for Tuesday, June 11th.